Welcome to Signal Stock. This week the market gave us something rare, a single stock, and a single reason. Broadcom rose over 11% on the same days the wider technology market was falling. Not on a rumor, not on an analyst upgrade, on a signed contract with Apple worth more than $30 billion. And that contract did something more interesting than ad revenue. It killed the biggest fear hanging over the stock. Let us break it down. First, the accountability check, and this week it has a real milestone in it. 26 forecasts confirmed. Every single one moved in the direction we called. 19 of 26 landed inside their full price range. Now, here is the honest part. Look at week 2. Only 2 of 9 forecasts landed inside their range that week. That was our worst week, and it happened because our ranges were too narrow for a sector-wide move. So we changed the method. We started sizing every target to a stock's own weekly volatility rather than drawing lines on a chart. Since that change, every single forecast has landed inside its range. Last week's Micron call is the one we are proudest of. The whole market was treating that stock as broken. We put the base case at $975. It closed at $991, under 2% from target, on a stock everybody had written off. Now to Broadcom. To understand why this stock jumped, you need to understand what was weighing it down. Apple was roughly a fifth of Broadcom's revenue. And for months, the market had been pricing in a very specific fear, that Apple would eventually design its own chips and simply walk away. That fear is a big part of why Broadcom fell from $495 earlier this year. Then Apple signed more than $30 billion, over 15 billion custom chips, built in the United States, running through 2031. Plus a $1.5 billion expansion of Broadcom's Colorado plant. The fear did not shrink. It got a 6-year expiry date stamped on it. And notice when this happened, the wider technology market was selling off that same week, and Broadcom went up anyway. That is what a company-specific catalyst looks like. Now, a technical point that matters for anyone thinking about entry. Broadcom is not breaking out. It sits about $94 below its high for the year, with real resistance overhead, and its momentum reading is still below its own average. That is a recovery inside a range, not a runaway trend, so we keep our target band at the default width and let the chart's own support and resistance levels confirm the edges. Here is the detail worth sitting with. An 11% week that leaves the momentum reading at only 55 tells you something important. The market has not overpaid for this news yet. Compare that with a stock that breaks out with a reading in the mid-70s. Same direction, very different risk on your entry. And our stop sits at $358, roughly 1 times the stock's typical weekly swing below entry. Any tighter and ordinary weekly noise would knock you out of a perfectly good position. So to close, Broadcom is a buy across all 3 of our timeframes, and it earns that on the cleanest kind of evidence. A signed, dated contract with a named counterparty. But be clear about the risk, because it has not disappeared, it has moved. A small handful of very large customers still drive most of Broadcom's revenue and most of its future growth. Apple is now locked in until 2031. The others are not. That concentration is the thing to watch, and it is the thing that would break this thesis. If this was useful, subscribe and hit the bell for new signals every Friday. And here is the question to leave you with. When a company signs away 6 years of certainty with its biggest customer, is the market pricing the deal? Or is it still pricing the fear?